21 miles. That's the width of the passage, carrying 1/5 of the world's oil every single day, roughly 20 million barrels funneled through the Strait of Hormuz. During the tanker war, over 400 ships were attacked in these waters. In 1973, an embargo sent prices up 4 times. In 2019, a single drone strike jolted global markets within hours. But petroleum is only part of what this choke point controls, and what a sustained closure would actually trigger reaches far beyond fuel prices. At its narrowest point, the Strait of Hormuz measures just 21 nautical miles across, a distance that feels almost trivial on a world map, yet carries consequences far beyond its scale. Each day, more than 20 million barrels of oil and petroleum products are funneled through this slender corridor. That is over a quarter of all oil moved by sea worldwide, and about 1/5 of total global petroleum liquids. To put it another way, every 5th barrel of oil burned in cars, factories, or power plants anywhere on Earth has traveled this passage. The Strait's geography leaves no room for error. 2 parallel shipping lanes, each barely 2 nautical miles wide, are separated by a buffer zone. The rest is shallow water, rocky shoals, and the constant presence of warships. Most supertankers, very large crude carriers, and ultra-large crude carriers must keep to these marked lanes, their movements tracked by satellite and automatic identification systems. On a typical day, up to 24 fully loaded tankers snake through this bottleneck, carrying cargo worth over $1 billion per hour at current prices. The overwhelming majority of these shipments originate from just 5 countries: Saudi Arabia, Iraq, Kuwait, the United Arab Emirates, and Iran. Each relies on the strait as their main gateway to the world, with no alternative sea route. The numbers are stark. Saudi Arabia alone sends nearly 9 million barrels a day through Hormuz. Iraq, Kuwait, and the United Arab Emirates each depend on the strait for 80 to 100% of their oil exports. Even Iran, despite sanctions and periodic attempts at bypassing the choke point, moves most of its crude through these waters. On the receiving end, Asia stands out as the most exposed. About 84% of Hormuz oil flows east, with China and India accounting for the largest shares. China receives nearly 7.5 million barrels per day, more than half its total oil needs, from this single maritime corridor. India's reliance is even higher in proportion to its domestic demand. Japan and South Korea together import over 2 million barrels daily via Hormuz, leaving their economies acutely sensitive to any disruption. By contrast, Europe and North America draw less than 10% of their oil through the strait, though even these smaller shares are enough to ripple through global energy prices. Physical constraints reinforce the vulnerability. The deepest channel in the strait allows tankers with a draft up to 20.5 meters, but navigation is tightly controlled. During periods of tension, naval escorts and security zones can reduce throughput by several million barrels per day, as seen during past crises. There are pipelines that can bypass Hormuz, most notably Saudi Arabia's east-west line, but their combined capacity covers less than 1/5 of normal flows. In practice, the world's oil system has no true backup for the strait. This geography of power is not just about oil. Liquefied natural gas shipments, high-purity helium, and bulk goods for landlocked Central Asia also depend on the same lanes. But it is the sheer volume of petroleum flowing day and night through a gap barely wider than a city's main street that gives Hormuz its global leverage. One narrow waterway carrying 1/5 of the world's energy sets the stage for every supply shock, price spike, and policy scramble that follows. History has shown that the threat to oil flows through choke points like Hormuz is enough to jolt markets, sometimes even more than an actual loss of barrels. In 1973, an embargo by Arab oil producers sent crude prices soaring from $3 to over $12 per barrel in just a few months. A fourfold jump that triggered double-digit inflation and recession across the West. The world learned that policy decisions thousands of miles away could send shockwaves through every gas pump and grocery aisle. A decade later, the Iran-Iraq tanker war brought the danger even closer to the strait itself. Between 1984 and 1988, more than 400 merchant ships were attacked in the Gulf, over 150 of them oil tankers. At the height of the conflict, U.S. Navy convoys shepherded tankers through the so-called escort lanes. But even with warships on station, the fear of a missile or mine was never far from mind. A retired escort commander later recalled, "You could feel the tension on the bridge every time we approached the Narrows. One flare, one spark, and the whole world would feel it in their wallets." The market's response was immediate. Brent crude climbed 15% in the weeks after the first major attacks. Freight rates for oil tankers more than doubled as shipowners demanded hazard pay for every mile sailed through the Gulf. War risk insurance premiums for a single voyage soared from a few cents to over 14 cents per barrel, adding millions to the cost of every shipment. Even when global oil supply was not physically cut, the mere possibility of disruption forced prices up, costs that rippled outward to consumers and businesses everywhere. Fast forward to June 2019, 2 tankers were struck by explosives near the Gulf of Oman. The attacks lasted minutes, but the market reaction was swift. Brent crude futures spiked nearly 10% in a single trading session before settling. Shipping rates jumped 30% overnight as insurers doubled premiums for transiting Hormuz. The price shock was brief, but it offered a sharp reminder that even a handful of attacks can trigger a global reaction. Economists have mapped out how these price jumps feed into daily life. On average, a 10% increase in oil prices raises consumer price inflation by about 0.2 percentage points across Asia and other emerging markets. In energy-dependent economies, the effect can be even faster and larger. Higher oil prices mean more expensive fuel, pricier shipping, and costlier goods on store shelves. During the 1973 embargo, U.S. inflation jumped by more than 5 percentage points in a year. In 1990, after Iraq invaded Kuwait, oil prices doubled again, and the U.S. slipped into recession within months. Across these episodes, one pattern stands out. Markets react not just to barrels lost, but to barrels at risk. The fear of losing Hormuz, even for a few days, can send prices soaring and economies reeling. As one convoy officer put it, "You don't need to close the strait to cause chaos. You just need to make people believe you might." When oil stops moving through Hormuz, the consequences unfold with mathematical precision. Energy economists describe it as a chain reaction. Fewer tankers leaving the Gulf means less oil reaching refineries, and the gap between supply and demand sends prices into overdrive. The 1990 Gulf crisis offers a textbook example. In August of 1990, Iraq's invasion of Kuwait removed nearly 4 million barrels per day from the market. Within weeks, Brent crude prices more than doubled, from $15 to over $32 per barrel, before settling back, but not before sending shockwaves through the global economy. The initial impact lands on the wholesale market, where futures traders and physical buyers scramble to secure barrels. Historical models show that a 30-day full disruption at Hormuz would lift global oil prices by about 10 to 13% almost immediately. Freight costs do not just follow, they multiply. Tanker owners, facing both real and perceived risks, demand higher fees for every mile. During 1990, freight rates for crude shipments jumped by 30% in less than a month, and war risk insurance premiums for a single voyage soared from a few cents to as much as 20 cents per barrel. That is millions of dollars in extra cost for each supertanker, passed straight to buyers downstream. But the price spike does not hit gas pumps overnight. There is a lag, typically 2 weeks, before higher wholesale prices filter into retail fuel costs. For many economies, especially in Asia, the pass-through is quick and sharp. A 10% jump in oil prices historically raises consumer price inflation by about 0.2 percentage points in emerging markets. In China and India, where energy imports dominate, that effect is even faster. Consumers see higher fuel bills within a month, and shipping companies pass along increased freight costs to everything from electronics to groceries. The full transmission, from tanker delays to price spike to retail inflation, can play out in as little as 30 days, with secondary effects lingering for months as contracts reset and businesses adjust their budgets. Freight and insurance costs often double or triple in the wake of a major disruption, and these increases ripple outward for 1 to 3 months. The result is not just costlier oil, but higher prices for goods that depend on global shipping. In 1990, the United States entered a recession within months of the oil shock, and central banks worldwide faced the dilemma of rising inflation just as growth slowed. The mechanics are clear. When Hormuz stutters, the world economy feels it in every link of the supply chain. Oil is not the only thing riding the narrow lanes of Hormuz. Beneath the headlines, the world's supply chains hide other dependencies that are just as vulnerable to a sudden stop. Qatar, for example, supplies about 40% of the world's helium. Every shipment leaves Ras Laffan in specialized tanks, moving alongside liquefied natural gas carriers through the same strait. Helium is not just for balloons. It is essential for making semiconductors and running MRI machines. When a delay hits Hormuz, it is not just energy markets that feel it. Semiconductor procurement teams from South Korea to California watch shipping schedules nervously, knowing that a 5-day holdup can set back chip production for weeks. The cost is not just measured in lost revenue, it is measured in missed product launches and empty hospital wings. Liquefied natural gas, or LNG, is another hidden flow. Since Europe's pivot away from Russian pipeline gas in 2022, Gulf LNG has become a lifeline for both Europe and Asia. A closure at Hormuz means tankers must reroute around the Cape of Good Hope, adding 10 to 12 days to every voyage and raising freight costs by as much as 20%. In the dead of winter, that delay can tighten gas inventories across Europe, pushing up prices and forcing utilities to scramble for alternatives. Each extra week at sea means higher bills for millions of households, and the knock-on effects reach factories, transit systems, and even food supply chains. The impact does not stop at the water's edge. Landlocked Central Asian exporters, Kazakhstan, Uzbekistan, Turkmenistan, depend on Iranian ports like Bandar Abbas to reach global markets. When Hormuz is blocked, their shipments must detour through the Caspian Sea or overland by rail, adding a price premium of $3 to $5 per barrel. For economies already squeezed by distance, that extra cost can tip trade from profit to loss. The 2021 Suez Canal blockage offered a vivid analogy. 6 days of stoppage delayed 12% of global trade and cost an estimated $9.6 billion per day. Hormuz, though smaller in size, carries outsized risk. A single choke point can ripple through supply chains far beyond oil, exposing how tightly modern prosperity is wound around a handful of vulnerable arteries. For procurement leads in high-tech, energy, and logistics, Hormuz is not just a distant headline, it is a daily calculation of risk. Stagflation is the economist's worst-case scenario, rising prices and slowing growth, happening at the same time. In plain terms, it's when the cost of living keeps climbing, but jobs and incomes do not keep up. Normally, a central bank can fight inflation by raising interest rates, or fight a slowdown by cutting them. Stagflation is the nightmare scenario where you need to do both at once and can't. To understand the risk, analysts draw a line. At what point does an oil shock tip the world into stagflation? They use scenario bands to map out probabilities. For a 30-day closure of Hormuz, the chance of true stagflation, meaning both high inflation and stalled growth, is less than 10%. If the disruption drags on for 90 days, the probability jumps to about 30 to 40%, especially in Asia, where dependence on Hormuz oil is highest. A closure lasting 6 months pushes the risk above 50%, with inflation running at 4 to 5%, and global growth dropping close to zero. These numbers are not just theoretical. They reflect how quickly higher oil prices pass through to everything from fuel and shipping to groceries and rent, and how little room central banks have to respond when both inflation and recession threaten at once. Central banks find themselves in a vice when Hormuz closes. As oil prices surge, the first shock appears at the gas pump and then spreads through freight bills, manufacturing costs, and grocery receipts. In Asia, where dependence on imported energy is highest, a 10% jump in oil prices typically adds about 0.2 percentage points to consumer inflation within months. But the pain does not stop at higher prices. As shipping costs multiply and supply chains slow, economic growth falters. Factories cut shifts, trade volumes shrink, and investment plans stall. This creates a classic policy dilemma. Raising interest rates might slow inflation, but it also risks pushing growth even lower, sometimes close to zero. Cutting rates could support jobs, but only at the cost of even faster price increases. In a sustained Hormuz disruption, global inflation can push into the mid-single digits while growth hovers at or near zero. Central bankers face a bind with no easy answer. If they act too aggressively, they risk recession. If they hesitate, inflation can spiral. The result is a world where ordinary people pay more for less, and policymakers run out of good options just as the stakes reach their peak. Not every country feels a Hormuz shock in the same way. Oil-exporting nations that can operate outside the strait, like the United States, Norway, Canada, and Brazil, stand to benefit as prices climb. For shale drillers in the United States, whose break-even costs often hover between $50 and $60 per barrel, a 10 to 15% jump in global prices can turn marginal wells into profit centers almost overnight. North Sea producers and Brazilian offshore platforms, with stable output and Atlantic shipping lanes, capture higher margins without facing the same risks or delays. Gold and other safe haven assets also rally, as investors seek shelter from energy market turmoil. Defense and aerospace firms see new contracts as Gulf states and global powers boost naval spending to secure shipping lanes. But for oil importers, the pain is immediate and uneven. India, Japan, and South Korea face some of the highest exposure. More than 60% of their oil imports arrive via Hormuz. With little domestic production and few alternatives, even a brief disruption threatens to widen trade deficits and strain national budgets. Central Asian economies like Kazakhstan and Uzbekistan are landlocked and reliant on Iranian ports, and must reroute exports at a premium that can erase their competitive edge. Smaller Gulf states, including Bahrain and Oman, risk capital flight as investors react to regional instability. In this system, price shocks create clear winners and losers, reshaping fortunes along the fault lines of geography and trade. Strategic petroleum reserves serve as a global emergency brake when oil shipments through Hormuz are cut off. The United States can release up to 4.4 million barrels per day, while other International Energy Agency members and China together can add another 2 to 3 million barrels per day. In a crisis, these combined reserves could supply 6 to 7 million barrels a day, about a third of the 20 million barrels that usually pass through the strait. This buffer is significant, but short-lived. Most projections indicate reserves could be drawn down at this rate for only about a month before supplies dwindle or logistical hurdles slow further releases. Liquefied natural gas adds a limited cushion. New United States liquefied natural gas export terminals are set to provide 40 billion cubic meters of capacity, helping Europe and Asia reduce oil-fired power during shortages. Still, the scale of liquefied natural gas is modest compared to oil demand. Fossil fuels remain dominant, making up roughly 80% of the world's primary energy mix. Reserves and alternatives can soften the blow, but they cannot fully shield the system from a major disruption. Every decade, the world is reminded that it built its economy on a single narrow waterway in one of its most volatile regions. Every decade, it promises to change. The Strait of Hormuz is not just a geography problem. It is a mirror reflecting exactly how dependent, how fragile, and how short-sighted modern civilization chooses to be. Let me know your thoughts in the comments below.